Happy Friday. We are back with another episode of the Tech Behind FinTech. Really excited today. We have Stock Card CEO Hoda Mehr here to discuss technology trends pushing retail investing. This is going to be a really exciting show today. Hoda, how are you doing today?
I'm very well. Thanks for having me. I'm excited to be here.
I'm excited. There's so many questions that I want to ask you, so many questions people are asking me behind the scenes, and I'm really excited to get into it. But before we get into it, we have to, of course, read Hoda's amazing bio. So Hoda Mehr is the founder and CEO of StockCard. Hoda has lived and worked in several countries and cultures, including the Middle East, Canada, and the U.S. She's an economist and has an MBA from the John Molson School of Business. Before starting StockCard, Hoda worked on bringing to market several multi-million software products. She then turned her side passion for investing and launched StockCard to solve the problem she discovered while running a 30,000 member private community of stock market investors on Facebook. Hoda lives in Southern California with her husband and puppy Rottweiler. On social media, Hoda talks about the future of retail investing, the pursuit of 100 bagger investments, and her journey in building StockCard. I do have to say something though about your bio, Hoda.
Yeah, go
Your
ahead.
Rottweiler is not a puppy. That dog is huge.
Everybody say that to me. I always have that, and everybody say that he's so big, but in our point of view, he's still like an 8 months 8 months old puppy. But yeah, he's now grown up very well. So.
It's like, definitely not a puppy. We don't have a picture to show, but it's a pretty big. So we are streaming live from a couple of platforms. Let me say we're streaming live from Facebook, LinkedIn, YouTube, Twitch, and we're also streaming live from Instagram. So my Instagram people, I see you joining. How are you guys doing today? If you want to post questions, please feel free to do so on LinkedIn, Facebook, YouTube, and Twitch. Your comments will be part of the video. On Instagram, you can go directly to our website, Tech Behind FinTech. It should be pinned. No, it's not pinned actually, but I will pin it right now. And from there, you can post a comment that will make it part of the video. Shout out to everybody joining. I see you guys. I appreciate you guys. Okay, so how we usually kick off our show. First of all, Tech Behind FinTech, we talk about the technology that powers the money, and we get into that. And we like to kick off our show by talking about current news that happened this week and then segueing into our topic. Big news of the week. Everybody's talking about this guy. Elon Musk has acquired Twitter. It's official as of today. Due to the acquisition, Twitter has been delisted off the New York Stock Exchange. So, Hoda, talk to me about that. What happens when a company that was public, that was trading, now gets delisted? How does that process work?
Yeah, I mean, you're right. It's the big news of the week, or it's been a few months actually, and finally Elon pulled it off. So to answer your question, when a company is publicly traded, it means that public, you and me and everybody else, have equity or a stake in the company. When it goes private, the acquirer, the person who, in this case, Elon Musk and the company, basically pay off all those global public stakeholders or stockholders, whatever share, the price that was agreed on. In this case, it was a $44 billion transaction, I believe. And everybody basically, there are no more stakeholders in the company, and the private company, in this case, Elon and his team, and I guess the people who invested in this transaction will take over. So that's the main difference. From an ownership point of view. So from a leadership point of view, there's so much going to happen, obviously, especially for this transaction, right? Elon has already, it sounds like, got rid of the CEO and CFO and the entire legal team. So he's really in there to make changes. We're going to see what are the changes he's going to make in the future. But that's typically what happens when a company goes back private. It's really because they have some strategic change in the direction of the company, so they don't want to be distracted with commentary and lots of stakeholders and stockholders, so they want to really focus on something. And so very typical to see these kind of drastic change of direction when company goes back private, basically.
It's interesting, with Elon, he's obviously a huge Twitter user, and due to some of his posts previously, he has gotten fined. So I guess this is something he doesn't have to worry about with regulators now, with the scrutiny of that. Also, I read that he said he plans to take it back public in 3 to 5 years.
Yeah. Well, I mean, I don't know whether he's going to do it, but that's again goes back to like decision to make a lot of strategic changes. So that's why companies go off, right? Public market, because they want to make a lot of changes, and it would impact in the short term, it would impact sales, it would impact profitability. So if you are public, you're gonna be under scrutiny of the public eyes and investors. There's a lot of good things in public market, but from a management point of view, there's a lot of distractions as well, right? Like you gotta manage the narration in the market about your company, and if your stock price goes down and up because of 1 quarter or 2 quarters of different changes. So it's very common to see that companies that would want to change make a very big strategic decision or strategic pivot in their direction, they go off of public market. They do the changes, bring back the company to profitability or to its new direction. And then a lot of times maybe they sell it or they go back basically public. So yeah, it makes sense what he's doing. He needs this like few years, I guess, of really, really drastically changing, implementing whatever strategy he has in mind for the company.
It's interesting. So, I mean, and then I know today's topic's on retail investors. So just once again, I would think that I'm a retail investor. I own Twitter stock. I'm going to wake up Friday or Monday, and all of a sudden there's going to be money in my account as opposed to the stock. They're just going to pay me. I think it was at $54. They're going to pay out the retail investors that were invested in Twitter previously.
Yeah, that's basically what happens. You wake up and there's money in your account. And that's it. You could redeploy that money to other things, which is always exciting to have, exciting to do.
All right, excellent. As always, anytime we're talking, I like to think of this as a conversation. So please, from the audience, chime in. If you have questions, if you want to lend your input, put it on the chat, and we'll post it as part of the video. Moving on.
Say something about Elon. I was thinking about his approach to fundraising for this whole acquisition. And I don't know whether your audience or you have looked at it before, but his approach to fundraising is super interesting. How he obviously needed a lot of cash to be able to make this transaction happen. But if you read through his messages that came out, his text messages, his approach, and he's sort of like nonchalant, and it's like so like offering this opportunity as a gift to anyone out there who want to be part of this fundraising. His approach is super interesting as a founder, looking at him and how he basically raised money for this. It's very interesting. Obviously a topic for another conversation, but if there are founders in your audience, I do highly recommend going through his text messages and kind of like digest his approach to fundraising, which is quite different from a lot of other fundraisings.
Now, I would think it's different. I mean, I know Binance put in $500 million towards the acquisition, but the thing I'm thinking about is like he can do that because he's Elon and the things that he's done previously, right? With Tesla and SpaceX and things like that nature. But if a founder with not the same track record, I wonder how that will play out for them.
Yeah, no, obviously, like you can, if you don't have that track record, you can't do it the way he does it. But there is some fundamental learnings from his fundraising, is that if you're offering your company to investors, you obviously you believe that your company is going to be significantly bigger and you're going to generate significant amount of revenue and significant amount of return for investors. So yeah, maybe it's not about being rude or something like that, but it's more about like changing your mindset and thinking about, I am offering this unique opportunity to you as an investor to be part of my journey. And obviously there's the other way around, right? And they're being part of your journey to support you. But a lot of times founders, like, really, we all go in, and I'm guilty of that, with this like, please come and help us. But it's more about like, no, this is a mutual partnership. I'm giving you this opportunity to be part of this amazing return generating life event. Be part of our company, and obviously I want you to be part of our company. So it's very interesting. Obviously you can't pull Elon the way he does it, because you don't have all the backing of like being the richest person in the world, and obviously have proven yourself several times in the market. But the approach is still, in my point of view, quite applicable to a lot of other fundraising.
What I've heard from founders, and just looking at it, even from the investors as well, is the founder. It's less of you. It's more money. Like, it's more powder out there. The right opportunity, that's the hardest thing to find. So if you're offering that, you're not just a commodity, right? Like, you're something special that like everybody would jump on. So and I think sometimes, because you know how much you need to keep the lights on and keep it going, it seems like, from the outside looking, the VC, the investor, they hold the cards. But a really good idea and a really good product that's making money, can generate 10, 100x on the dollar, that's a jewel. So you are literally the star of the show. Is that you're right, from a mindset perspective, it's hard to put yourself there when look, I need this because cash flow is running out. It's a really great thing. So I could totally see how that could be difficult.
Yeah, no, exactly. It's all about mindset. As a founder, early days, or maybe even at later days, it's all about like, how would you position yourself against everybody else, right? It's all about mindset.
Oh, 100%. Jumping into the next one before we move into the topic of the day. Credit Suisse cut 9,000 jobs, and they want to raise $4 billion in capital as part of a transformation plan. So I want to talk to you. So it looks like the quarter earnings just came out, and they posted a third quarter loss of 4 billion in Swiss francs. That's about $4 billion, compared to analyst expectations of a 567 million Swiss francs loss. So it looks like they're doing a major restructuring, and they already got Saudi National Bank to commit to up to 1.5 billion and to take 9.9% of the stake. So a few things in this article that I want to talk to you about is, first of all, quarterly earnings. And everyone, even the retail investors and institutional, everyone hangs on that. Can you explain that process, of the quarterly earnings, and then how people then make their stock choices pre and prior to it coming out and so forth?
Yeah, well, so quarterly earnings is supposed to be a report by the management team to the stakeholders or stockholders of the company in terms of the progress of the company in the last quarter, right? That is the essence of it. And, public or private, you always do that to your investors. You go back and kind of provide an update. That's just the essence. It's a very good practice in logically to provide updates, obviously, on your progress. But what happens in the market or in reality is that it turns into, instead of an update on the progress of the company, turns into this whole shenanigan around creation of news and creation of conversation and creation of debate around the company's long-term future. So there's a lot of argument out there in terms of how to use quarterly earnings report. But right now, what is happening in the market is that analysts and media, financial analysts and financial media, look at the company and look at what the management said in the previous quarter, and look at what's happening in the market, what happened to other companies similar to that company, and they make some forecasts about what they should expect from the company to deliver this quarter. And then they go into the quarterly earnings report or conversation with management and compare their expectation with what really happened. And so as we know, investing in the stock market is all in the short term. It's all about expectation, right? What do people expect to happen? So before the earnings, if there's positive outlook and they believe as a whole, that this company is going to do very well. People jump in to buy before the actual thing happens. And then when the actual earning comes out, and then people, by people, I mean investors, financial analysts, financial media, they start comparing that expectation with the actual reality. And then sometimes it beats the expectation and sometimes it missed the expectation. And depending on beat or miss, the stock price gets impacted. So that's really the whole story of quarterly earnings report. In my point of view, it's not being used in the right way, because in a realistic world, we all know, even in our personal life, obviously a quarter is a lot of time to do things, but in a grand scheme of things, a quarter is a blip, right? It's a blip in like overall life of yourself or life of your company. So if a company is not doing well in one quarter, or if a company is just doing very well in one quarter, it means nothing in reality, right? In the reality of the long-term strengths of that company, it means nothing. It's just one data point in a series of many, many data points. So yeah, we don't use it very well, I believe, in financial media and financial analyst market. We basically use it as a way to trigger lots of conversations and clicks and stuff like that. But it's a good one data point in the lifelong of a company.
And so a question to follow up on that is, what's the best way that retail investors should use it based on what's going on? Obviously, people see their stock prices impacted every quarter. I know some people who trade options, they make tons of money. They know how to call it, so it's all different things going on. But what's your advice for a way a retail investor can leverage it?
Yeah. So personally, we have to, as they say out there, investing, it's all about finding your edge against everybody else, right? Investing is all about finding your edge against everybody else. As a retail investor, individual investor, you don't have any edge over AI and computers who can process information so fast and make investment decision based on large volume of data. So I don't really think for a retail investor, getting in and out of the market or trying to predict the direction of the market is really good way to do it. Most retail investors can pull it off. That's not, as a human, that's not where we have edge, right? Trying to predict patterns in large volume of data that is out there. So that's my personal view, and there's a lot of evidence to support that, is that our edge as retail investors is not in quick trading in and out of the market, right? Our edge from a retail investor point of view is that our ability to interpret the data in a better way, in a long-term way, right? Because a machine or an algorithm look at the data and says profitable, thumbs up, growth going down, thumbs down. Free cash flow went down, thumbs down. So they look at it in a very binary way and they come up with a score, and then they make their decision. These are the machines, but humans can see the context behind it, right? Profitability is down. Oh, there's a really good reason for it, because A and B and C, because we can read and we can understand and listen to the management and read the conversation that is happening or the reports that came out. So our edge as retail investors is that actually patience and not going in and out in the market, and basically understanding the context behind the numbers, and then make decisions based on the context as opposed to the actual the real signals that is happening. So that's sort of my point of view. That's what I do. That's what a lot of our users on StockCard do, and that's a lot of successful investors out there actually do it. Use your edge, which is patience and understanding the context behind the number as investors.
And that's a good segue. So can you explain StockCard and exactly what you do over at StockCard?
Yeah, at StockCard, we provide digestible insights for retail investors. So what is happening out there, as we talked about it, the data is exploding, right? The data, commentary, financial context and content is exploding everywhere, right? Social media and financial media and traditional media and blogs and YouTube and LinkedIn Lives and everywhere else. So we have this explosion of the data. Obviously, there's like financial reports that comes from companies. At Stockcard, we get and automatically collect and aggregate all that information, and we bring it into our data center. And then we have this, what we call a data insights engine. And this engine basically collects all that data and transform them into digestible insights that anybody can understand. So our goal is to help individual investors to make investment decisions based on facts and less on emotion. So instead of getting, if something goes up 10% and get emotional about it and try to like sell it immediately, our goal is to be able to show that it's better to hold it right now, or maybe it's better to sell it. So that's what we do. Collect, aggregate, and automatically all the information is out there, transform them into digestible insights that anybody can understand, so people can make better investment decisions based on facts and less on emotion. Our ultimate goal is to help individual investors to become the best asset managers for their own assets, right? Because retail investors are the people who manage part or all of their assets themselves, and we want to make sure they are the best manager of their own assets and generate the highest return for their assets. That's what we do at core, at the core of a Stockcard, basically.
No, thanks for that. That's really useful to know. So I want to ask you, I think, and this is my opinion, correct me if I'm wrong, I think 2020 was a major shift for the retail investor. I think when the pandemic happened, and then you had things like Wall Street bets and the Reddit channel, and the short squeezing, and basically an army, a tool that allowed an army of retail investors to collectively go against hedge funds. I don't know if we've seen that prior in history. What are your thoughts on that?
Yeah, I think what happened in 2020 and 2021 and still going on right now is this reflection of sort of this fundamental change in technology and in demographical shifts in the retail investing world. It just happened to represent itself in 2020 in that shape of sort of like the GameStop short squeeze and rally. So that you're right, it never happened something like that. We don't have examples of that sort of like collective power of individual investors. But I think it could have happened in any other shape or form. It just happened to be that GameStop became that representation of it. The underlying trends, the underlying fuel for this movement, this uprising of retail investing is quite interesting. It's basically what we've been talking about so far. The explosion of the data, the minute update and access to data and information by everybody, including retail investors. The ability to communicate and align and have conversation online, not only from like TV to you, not from just the financial analyst and you as a retail investor to consume it, but as this network of conversation between individual investors and analysts and contributors to the market. The ability to transact fast and at low cost, at zero cost, basically, because this thing that happened with GameStop could have never happened if you had to pay $30, $40, $50 per transaction on your brokerage. This would have never happened, right? Because the transaction is free. It's just so easy for people to make transactions and they can do it instantly. And the other one is convenience of doing these transactions from your home. If you had to wake up, stand up from your couch and go to your desk and fire up your computer and then load a website and log into your password and kind of like find the transaction, put the order that it would take like a 24-hour for it to get executed, this would have never happened. Right now we have all of our phones and we like rely on a couch and kind of like transact from there. So what happened in 2020 is the result of this fundamental change in trends in retail investing. It just represented itself in GameStop's basically short squeeze. And it's interesting. So GameStop may or may not be over, the short squeeze may or may not be over, but those fundamental trends, the underlying trends and pushes are continuing, right? There's no stopping to them, basically.
No, I mean, it's interesting you say that, right? Because one thing, it's a few things that could translate to other industries. Speed, convenience, and social. So, like you said, transactions are fast. Oh, and of course, free. So 2019, Robinhood introduced free transactions. After that, other exchanges, TD Ameritrade, Schwab, everybody started to jump on that bandwagon and say, you know what? Because I'm a customer who remembers from 10, 20 years ago paying 30, then it was at one point it was 10, and then now it just went to 0, right? So we have the free aspect, we have the social aspect, right? So now we could communicate on different social networks and platforms and different Discord groups and Reddits and about a particular stock. We have the scale in that sense. We have the speed of the transaction, and we have convenience, right? Those elements right there, when you were looking at it from a retail investment, but those same elements have been used in other verticals and had major impact in terms of digital transformation. So I like how you extracted those core things, and I think you can definitely put it at different verticals, and you would see similar, right?
Yeah, no, I agree. I think if you think about it, like the explosion of sort of putting it in different contexts, the explosion of TikTok, if you think about it, it's very similar to the explosion of retail investing from a speed and ease and no cost element. So if you use TikTok to upload something, if you've ever tried to do that, I recently started posting some stuff on TikTok. I was just like mind blown on like how easy is to upload a video, add very interesting colors and pictures and stickers and things like that, add your caption with so much accuracy, and basically do some hashtags, and then instantly have access to hundreds of people, or if in my case, because I'm just starting, but like in case of some other accounts, and millions of people in a matter of seconds. So when you think about the explosion of TikTok and self-publishing, it's the same thing that is happening in the retail investing. Things become free and convenient. It's just suddenly we have a drastically different volume of that thing. So retail investing is one, obviously publishing, self-publishing is another one. The other thing about retail investing is very special and very, very unique to the retail investing space is this fundamental underlying demographical change. So what is happening, it's been dubbed as the big wealth transfer. And that means baby boomers, who are parents' generation, they are basically retiring. And then gradually they basically transfer their wealth, their house, whatever they accumulate over their life, to the new generation, which is millennials and Gen Zs, right? And it's estimated that at some point it was $60 trillion. Now it's $80 trillion worth of investable assets that are transferring hands in the next decade from baby boomers, from parents' generation to the new generation. So that's good. It's the biggest wealth transfer in history of humankind from one generation to another generation. So that's significant. But what's more even significant is that this new generation who are inheriting this wealth, they are extremely do-it-yourself generation because they have had access to the YouTube videos of how-tos, and they can go and whatever they want to do, they can search it on Twitch and TikTok and on whatever other social platform or blog or whatever they're following, and they can get a how-to. So this is a new generation that have extreme tendency to do things themselves as opposed to handing it off to somebody else. So if you think about that, speed, we talked about it, convenience, we talked about it, cheap or free, low cost, we talked about it. And then you add this $80 trillion worth of assets that are investable and go to one generation to another generation, to a generation who prefer to do it themselves, And that's massive. If you think about it, in the next decade, retail investing is going to explode, both in terms of volume and in terms of real impact, real dollar impact. Because yes, TikTok is exploding self-publishing, but there's no dollar attached to it. Retail investing is exploding the same way, but there's this $60-80 trillion worth of assets attached to it. And think about the power retail investors going to have. They have convenience, they have speed, they have intention to do it themselves, and they also have the money to do it. So that is that is quite powerful and unique to retail investing world.
I want to confirm, you said 60 to 80 trillion dollars in wealth transfer. Wow.
Yeah. Well, yeah. Well, obviously this includes houses, investable assets, right? It's not, it doesn't mean cash, but it means retirement accounts and savings accounts and wealth and that kind of stuff. Obviously, house and all other sort of like investable assets. But that's, again, it's all retail investing, right? It's going to go to a generation that Facebook or Meta platform did a research survey a couple of years ago about relationship of millennials and Gen Zs with money or financial institutions. And there was something around 80% of them don't trust traditional financial institution with their money. So they still have to use it, but they don't trust it. So as soon as you give them another tool, what that means is as soon as you give them another tool that they can do it, they empower themselves to do it, and they feel confident that they can do it, they're going to make a switch, right? They're going to make a switch. So it's very, very interesting and powerful what's happening in the world of personal finance and retail investing specifically.
I have some stats here. Let's take a look at it. I think it kind of leads into what you're saying. They're seeing a shift. So from July 2021 to April, U.S. adults are saying 50% have an investment account as they did. In terms of gender, 60% male, 41% woman. Generation now, the Gen Zs, millennials, they're increasing. So it lends in to what you're saying with your stat that you just pulled out. I love stats and I love these type of numbers, especially when you start mixing it with like experts like yourself, because it's like, oh wow, you start seeing the numbers and the charts, how it makes sense now. Also read this one, want to get into it. We can see the trends, like the amount of in the US year by year it's been growing. So I think they said right now 25% of our market represents retail investors. Do you see that? Do you see those type of numbers with what you're doing?
Yeah, so it is obviously this is Q1 of 21, and then we've seen the volume of participation of retail investing going down in the overall market, and that's because the market is down. But what is very interesting is that you have to compare, sort of like we are on the new S curve, right? So you have to compare where we are right now with 5 years ago. So you see that in something like a Robinhood data. A lot of people are worried about how Robinhood daily active users or monthly active users are down in the last couple of quarters. But I always say, yes, it's down from this all-time high of what was happening at the peak of like pandemic and the short squeeze and everything. But if you we're now on a new S curve, right? We're now on a new S curve, meaning that compare it to 3 years ago, we significantly have a lot more investors in the market, right? And all it takes is another boom in the market for those ones who've already created an account and already had some participation, some experience in the market, to come back and participate in the market. So it is quite interesting what's happening from if you zoom out on the last 2 to 3 quarters and then look at the last decade, you basically see a significant change in what's happening.
And looking at the ecosystem, this is from 2021. Just the stack, right? So where some people source ideas, some research tools they use, obviously the Robinhoods, and it, just the way they exchange money with Cash App is just really interesting to just see overall some of these tools. So would you say that we're talking about trends pushing it forward? Some of these tools that they're using, these are part of the technology trends. Would you agree with that?
Yeah, absolutely. So all these companies, by the way, they're missing the stock card. So whoever public comes, are you going to come talk to us and add a stock card? You're missing a big part of the market. Shout out to public comes. So I'm going to reach out to you guys. We should be there. But yeah, so all these platforms, the reason they're part of that fuel, like it's a double-sided thing. They see the change and then they want to serve the market, but they're also pushing the market forward. It's like a self-fulfilling cycle, right? So you see a push or you see a demand, and then you enable, and that enablement makes it much more stronger and bring in more people, right? So Acorns, Stash, Robinhood, Public, a lot of other folks, Twitter, obviously, and TikTok, they've all played a significant role, have a significant role in not only seeing the demand, but also enforcing the demand and like putting fuel on the fire. Yeah, because we talked about it, right? Like if you simplify it and if you make it drastically easier for people to do something at no cost, the human nature ends up doing that thing significantly a lot more, right? And we can talk about that. It's like a behavioral aspect of anything that humans do. If you simplify it and if you give things free to them, we tend to consume a lot more of whatever it is free and easy to do. So yeah, I mean, those companies obviously are part of that self-fulfilling cycle.
No, I mean, it's look, we can obviously go on and on about it. You know, your expertise in the market, what you're doing with Stock Card. There's just a ton and litany of questions. I want to be respectful of your time. So, you know, on that note, can you leave us where people can find you? Also, what new things are happening with Stock Card? What are you doing there? If you can, that would be great.
Yeah, absolutely. So something that is very exciting what's happening on the Stock Card right now is that we're working with financial creators, so YouTubers, Twitter personalities, that they've always been our partners, and we've always been supporting their community and their followers with their insights and that bringing digestible insights to them. One thing we recently started is enabling this new generation of financial creators to be able to solidify their strategy by launching an index. So an index is basically a formal representation of your strategy as an investor. So if you're a YouTuber and you're always talking about this specific methodology that you use in order to invest in the stock market, we help financial creators to solidify that and formally present that strategy in the form of an index. So we envision a world that every financial creator out there have their own representation of their strategy formally and independently put together. And basically they can really go out there and compete with any financial analyst out there, right? And to be able to basically show their strategy. So we recently launched our first creator branded index in the market for one of our partners, Joseph Hope, and his community is called Bowtie Nation. He has 600,000 followers on YouTube. And we're very, very excited. We have big ambitions and dreams for enabling this new generation of retail investors and financial creators to be able to work together and invest better. And as a part of that movement, we're actually doing a crowd fundraising on Republic to basically have the retail investing community be part of this fantastic future that we're building for retail investors. So if any of your audience is interested to be part of our journey, we are on republic.com/stockcard. And or you could reach out to me on a Stock Card. My email is hoda@stockcard.io, and or on social media. I'm everywhere on Twitter and LinkedIn, YouTube, and TikTok now, and happy to have a chat with you.
What I'm going to do is, so we can make it part of the video, I'm going to put your email address. Since you gave it, make it public. I'm going to put it on the video and add it right now. So now we'll be forever part of this video. And we know content lives forever. That's why we have to be careful of what we say online. All right, so that was part of it. So I actually, before you leave, I have some questions around the index part. So these financial creators, they're on your site, like the person that you just mentioned, they create their index of their strategy. Now the retail investor, how do they invest in that index, or how do they follow? How does that process work?
Yeah, so it will come later. So not every index wants to become an investable product, but a few of these indexes actually want to become an investor product, or the community would want to invest in that index. So that's sort of like our next milestone. That's actually why we're fundraising. We want to be able to fundraise to be able to fund that, taking the next step and being able to transform an index for a creator into an investable financial product, which is a fund that retail investors can invest. Right now, it's the index. You can go and you can follow it, and then if you do like that index, you could basically take the step to go to your brokerage and then like one by one buy the index constituents. But yeah, we basically, that's what we're working on right now, right? At some point in the future, people would be able to invest in their in the investment strategy of their preferred financial creator that they trust and like and follow.
And for users, they want to get access to stock card. Do they have to pay something? Do they register? How does that process work for the retailer?
Sign up, and it's free to sign up. You just go to stockcard.io and sign up. We ask for one email. There is a paid version for those users who are like power users, meaning that they do a lot more in the market and they want to do more than 5 or 6 or 7 research per month. But a lot of our features are for free. We provide a lot of value to our users at no cost, and we're happy to do it because we believe in our future and in what we're building for our retail investors. So yeah, stockcard.io, they can sign up there and use it for free forever.
That's awesome. I want to post that so it can be part of the video, so you guys see right there, stockcard.io.
Perfect.
So it's part of the video right now.
Thank you.
Hoda, thank you very much for your time. Love the conversation. I gained some insight from it. It's things that you mentioned that I didn't really think about it in terms of connecting the dots, right? I don't want to date myself, but I remember, the 90s and just getting into trading and figuring out and playing around with it and buying things that I probably should not have bought. One of the retail investment things that I've learned, just to keep it simple, like if you use the product and it's been working well for you, why not just own some of that product? And I learned that later on. I didn't think about it earlier off. And like you said, that's more of a long-term strategy. But in 2020, people have, it's a generation of people who've seen in a year instant millionaire. So everybody wants to instant. Like, I invested in Shiba in 2020. In 2021, I'm a millionaire. I invested in GameStop, do some options on, I'm a millionaire. So you watching that, you start getting into the thought process. Wow, if I could just put money in here, and by a year or a few months, I could make $1 million, right? But what you're saying is because you have algo trading, you have things going on AI. But for the human aspect, I love your point earlier. You mentioned our advantage is that we can put things in context. We can look, and when you start doing that, it lends to more of a long-term thinking, not a quick flip. So exactly. That was a really, I really enjoyed that. And I never heard that perspective before, in terms of, you always think the machines can do it better. You especially when you start looking at these AI systems that the major institutional houses use to just get, even if it's a blip for a millisecond, they can make, because they invest so much, so they can just make a quick spread. And you don't look at it from the perspective of what's my advantage or my edge as a human. So thank you for bringing that perspective. It's really, really great. Like all good things must eventually come to an end. That concludes our show for today. But definitely, listen, I would love you as a returning guest when things pop off in the market that we just want to make some sense of, right? I want to bring you back on. I want to talk to you about it. So,
that's what we do day out, right? So we're always happy to come back and have a chat about it.
All right, excellent. Well, guys, that concludes our show. Oh, before I forget, next week is our 100th episode. 100. So we're going to be celebrating that. It's going to be a panel discussion talking about the state of cybersecurity and fintech. You definitely want to tune in. I'll be shooting some videos leading up to the show, just the whole journey of us reaching 100 now, and just being consistent at it. So 100th episode, November 4th. Tune in. Panel discussion with some previous guests, experts in their domain. It's definitely something you do not want to miss. And we'll be advertising it, throughout the week. So, like always, same time, same back channel. Next week, 12 p.m. EST. This show is sponsored by Strategic Generation. They provide SOC 2 and cybersecurity services. Thank you all for your time. Thank you for tuning in. Those who are not live, but we'll be watching this a month from now, a year from now, 10 years from now, I thank you in advance. Hoda, that concludes our show. You have a great day. Stay offline for a second. We'll catch up, and I'll conclude the show right now.
Thank you very
Cheers,
much.
everybody.